We continue our coverage right here on Bloomberg Television, counting you down to the close on the final trading day for the month of May. And of course, the last 5 months have been all about tech, and a lot of people really raising some questions here about the tech rally and how sustainable it might be. Strategists over at Citi, led by Chris Montague, actually writing in a note saying that position risks are very much biased towards profit taking, which could create a headwind against the rally. Meanwhile, over at Barclays, Emmanuel Coe basically saying that he sees scope for further gains as investors give in to the fear of missing out, FOMO. He's sticking with an overweight rating on the sector, saying broader equity exposure is neutral at best despite the tech rally. Let's get a view from, well, someone who follows this very closely. Richard Saperstein joining us right now. He's the Chief Investment Officer over at Treasury Partners. Treasury Partners has about $9 billion in assets under management. Are you buying this rally?
I don't share the enthusiasm of the S&P when it comes to earnings or the outlook on the economy. And all the heavy lifting, as you mentioned, has been handled by big tech. And right now, 80% of the market of the stocks are underperforming the S&P. Yeah. So basically, my job is to protect capital. And what we've been doing is we're underweight equities, and we're moving equity money into fixed income. Okay. Because we get a natural hedge there. So if I have bonds and earnings slow, economy slows, stocks go down, bond prices will go higher. Yeah.
Well, I am curious, too, when we look at the current state of the fixed income market, there are a lot of gains that have been locked in already, if you will. And I know there are some folks, we had a few folks on this program earlier talking about this idea of future returns, meaning later in this year here. Do you think that's going to be meaningful? Are we talking like single digits, double digits, what? The potential?
Well, right now, the coupon rate on high-grade 10-year paper is 5%. Right. So if we get a 1% decline in rates, we're going to have basically an 8% increase in those bonds. So that's on the corporate side. If we look at the muni side, right now 380, 390 on tax-free longer-term yields, which gross it up to a pre-tax equivalent of 7.5%, 8%, and all of a sudden we're at the market's pre-tax return over long periods of time. So, you know, it's very important for me, who can allocate assets among different asset classes, to find the one that'll probably do best with the lowest risk.
One thing that's come up, I know, in your discussions with clients is this idea that we're unwinding 15 years of really cheap, even free money, and the fallout from all of that. Psychologically, what kind of shift in mindset does that require of investors, and how much, to what extent have they made that pivot?
Oh, it's huge, because there have been a profound number of businesses, companies, and investment strategies that have been built on a zero interest rate environment. All of a sudden, we also got $5 trillion in fiscal stimulus. We got $4.5 trillion of quantitative easing. So there's this been huge push of money at low interest rates into the system. Now we're reversing it. So investors have to basically reconnect the future investment strategy. And it starts with realizing that bonds now can provide protection in a fully asset allocated portfolio. Secondly, leverage has to come down in the system, because there's a lot of companies with floating rate debt. Figure that it was previously at, SOFR plus 200 basis points. Now it's SOFR at 5%, but plus 600 basis points.
Different ballgame completely.
Completely different. Mindset has to change on the investment strategy.
So I wonder to what extent that explains why people are so convinced that the Fed will eventually come in to cut rates. I mean, it was not so long ago that the consensus was multiple rate cuts by the end of this year.
Yeah, we don't see cuts really out until at least Q1 of 2024. But there's so much fixation on the Fed, and I would be looking at the yield curve. Think about it. Right now, absolutely every part of the yield curve is below the Fed funds rate. That tells you something. It tells you we're going to have a slowdown, and inflation has remained very sticky. So I'd expect Fed funds to remain where it is, potentially a little bit higher. But in 24, we're going to have a slowdown, and rates will go lower. And that's one of the reasons why we're extending maturities on debt.
How far out are you going? How far are you willing to take?
We're buying 20-year final maturities with 8 to 10-year calls. Okay. We're buying 10-year high-grade corporates.
And you think that's going to be safer than short-term treasuries, which everyone has sort of piled into?
Yeah, I think that's the Venus de Mayo, of trades, because what are you going to do when rates drop and your reinvestment is at 3.5%. You basically are, getting 5.5 for 6 months, and then you've got to reinvest.
Yeah.
So unless your window is a 1-year horizon or an 18-month horizon, you definitely should be extending maturities to capture any benefit from a declining rate environment.
One final question for you. We were talking about safe havens, defensive sectors earlier, and you haven't seen utilities or healthcare really get bid up because big tech has replaced them. What's the appeal of a utility sector or of a healthcare sector right now?
They both have nuances that will do well or not do well in certain environments. I can tell you that we're overweight big tech, defense, and oil. Not doing well today, okay? But there's different factors, whether it's, take a look at AI and big tech, all right? The large tech companies have basically done $700 billion in CapEx over the last 5 years. Microsoft, $100 billion. Apple, $100 billion. Google, $150 billion. They're expensing this on their income statement, but there's value being created on the balance sheet. And it's starting to emerge, new product development, AI, all that creates great value in these companies, which is why we're inherently overweight and big fans of large cap tech.
All right, we're going to have to leave it there. Great perspective. Richard Saperstein, he's the CIO over at Treasury Partners, helping you count you down to the closing bell. Amy Kong going to be joining us a little bit later in the program over at CI Barrett Private Wealth, the Chief Investment Officer there. Plus, a closer look here at the FDIC's problem bank list. It actually increased in the first quarter. We're going to have the latest takeaways from that report and a look at one of the biggest decliners of the day, Advance Auto Parts, plunging the most on record after cutting its guidance. That's our stock of the hour. All that and more coming up in just a bit. This is Bloomberg.